My name is Natalie Mercer. I'm 37 years old, and my mother invited me to dinner so she could humiliate me in front of everyone who mattered to her. She called it a family reconciliation night. She said it was time to put distance behind us and start fresh. She insisted I come early to help her set the table, the way I used to when I still lived at home. I should have known better. The house was already full when I arrived. Not just family. There were business partners, longtime clients of my brother's logistics company, and 2 couples from our church. It wasn't a reconciliation dinner. It was an audience. My brother Daniel greeted me with a smile that didn't reach his eyes. He had taken over daily operations of Mercer Freight 3 years earlier when I left the company. My departure had not been dramatic, but it had not been gentle either. I moved into financial compliance consulting. He stayed and expanded the business aggressively. Dinner began politely. Wine was poured. My mother made a toast about unity and second chances. Then she turned to me. "Natalie has been finding herself," she said lightly. "It hasn't always been easy." A few guests chuckled politely. I kept my expression neutral. She continued. "You know how it is when someone thinks they're too good for the family business and then realizes the world isn't so forgiving." There it was. Daniel leaned back in his chair. "Some of us stayed and did the real work," he added. The implication was clear. I had left. I had failed. I had crawled back. That part wasn't true. I hadn't come back for money. I hadn't asked for anything. But that was the story she wanted told. One of the clients asked casually, "So what are you doing now, Natalie?" Before I could answer, my mother replied for me. "She works in banking compliance," she said, lowering her voice slightly as if the word were unimpressive. "Paperwork, internal audits." I met the client's eyes. "Financial risk and regulatory oversight," I clarified calmly. Daniel smirked. "Sounds thrilling." "It is," I said evenly. "Especially when companies expand quickly." My mother set down her fork. "Daniel has grown Mercer Freight beyond anything we imagined," she said proudly. "We don't all have the stomach for that kind of responsibility." The humiliation was deliberate. She was framing me as cautious, timid, unnecessary. What no one at that table knew was that 3 weeks earlier, a routine internal review crossed my desk at the bank. The client name attached to the flag transfers was Mercer Freight. Large outbound transfers structured just below mandatory reporting thresholds. Repeated wire movements routed through intermediary accounts. Inconsistent invoice coding. The file had been assigned randomly within the compliance department. To me, I had not requested it. I had not announced it. I had not acted on it yet beyond preliminary review. Regulatory procedure required neutrality. Family connection required silence. At dinner, Daniel continued speaking about expansion into new routes and international contracts. He talked about creative financing and moving faster than competitors. I listened. Creative financing is a phrase that compliance officers learn to dissect. My mother turned back to me one more time before dessert. "You see," she said warmly to the table, "sometimes leaving teaches humility." I looked at her calmly. "Sometimes audits do," I replied. The room didn't react. The sentence sounded harmless. Daniel frowned slightly, but he let it go. The evening ended with polite hugs and thin smiles. As I walked to my car, my phone buzzed with a system reminder from the bank. Preliminary review deadline approaching. 7 days remaining before mandatory escalation. 7 days. They believed the dinner had established something. That I was small. That I had no leverage. That I was outside the company's trajectory. What they didn't understand was that compliance does not operate on emotion. It operates on thresholds. And Mercer Freight had crossed one. The next morning, I returned to the office and reopened the Mercer Freight file. Compliance review is not dramatic. It is methodical. Every transaction is examined within pattern context. Every outlier is measured against regulatory thresholds. Emotion is removed from the equation. The flagged transfers were structured deposits and outgoing wires ranging between $9,400 and $9,900. The federal reporting threshold was $10,000. Individually, the amounts were not illegal. Patterned deliberately below the threshold, they became suspicious. Over a 6-month period, there were 43 such transfers. The funds moved from Mercer Freight's primary operating account into 3 intermediary LLC accounts. Those accounts then transferred consolidated sums offshore within 48 hours. The invoice codes listed as justification referenced international route development. No formal contracts for international expansion had been filed with the bank. That discrepancy triggered the initial review. Under anti-money laundering regulations, structured transactions designed to evade reporting thresholds require escalation. Intent matters less than pattern. My role was not to accuse. My role was to document. I pulled the KYC file, Know Your Customer documentation, for Mercer Freight. The original financial profile projected moderate domestic logistics revenue. The recent volume exceeded declared projections by 30%, without updated disclosure. Failure to update disclosure is not criminal by itself. Combined with structured transfers, it becomes reportable. I requested additional documentation through formal channels. The bank sent Mercer Freight a neutral inquiry, requesting clarification of recent transaction activity. Daniel responded within 24 hours. The explanation was brief. Operational efficiency adjustments related to new contracts, no material change in business model. There were no supporting documents attached. I reviewed the timestamps. His response was written at 2:14 a.m. Defensiveness often arrives quickly when exposure feels possible. I escalated the file internally for enhanced review. That meant another compliance officer would examine my findings to eliminate personal bias. I disclosed the family relationship in writing to my supervisor. Transparency was mandatory. "You're comfortable continuing?" my supervisor asked. "Yes," I said. "The documentation speaks for itself." He assigned secondary review but kept me as primary analyst. The enhanced review revealed something else. 2 of the intermediary LLC accounts shared a registered agent address with a consulting firm partially owned by Daniel. The ownership was not disclosed in Mercer Freight's banking profile. Undisclosed related party routing is a material omission. By regulatory standards, that required filing a suspicious activity report, if not resolved satisfactorily, within 7 days of inquiry. 7 days. The same number that lingered in my mind after the dinner. I did not think about humiliation while reviewing the documents. I thought about thresholds. Regulations do not bend because of family tension. If anything, they demand stricter neutrality. On day 3 after the dinner, Daniel called me directly. "You flagged something at the bank," he said without greeting. "I am not permitted to discuss internal reviews," I replied. "Don't play procedural with me," he snapped. "This is family. This is regulated finance," I said. "You're overreacting," he insisted. "We're scaling. There are timing adjustments. Then provide documentation," I answered calmly. He hung up without responding. By day 5, no supplemental documents had been submitted to the bank. On day 6, the enhanced review concluded there was sufficient pattern evidence to justify formal reporting under federal compliance requirements. On day 7, I finalized the suspicious activity report. It was not personal, it was required. The report did not accuse Mercer Freight of a specific crime. It documented structured transfers, undisclosed related party routing, and insufficient explanation. Once filed, the next step would not be mine. It would be the bank's. And banks do not attend family dinners. 7 days after the dinner? I was in my office reviewing a separate client file when my phone began vibrating repeatedly. First my mother, then Daniel, then 3 missed calls from numbers I recognized as Mercer Freight's accounting department. I let the calls continue while I finished typing the last line of a compliance memo unrelated to them. Once sent, I stepped into a conference room and returned Daniel's call. "What did you do?" he demanded the moment I answered. I completed a regulatory obligation, I replied. Our accounts are frozen, he said. All of them. Operating, payroll, credit line, everything. That meant the bank had acted quickly. When did you receive notice? I asked. This morning, he snapped. They cited suspicious activity review and pending investigation, then provide them with documentation. I said calmly. You filed that report? Yes. You blindsided us. No, I answered. The inquiry was sent 5 days ago. You responded without documentation. We don't owe you documentation. You owe the bank clarification. He exhaled sharply. Payroll is due tomorrow. That detail was real. 48 employees depended on those accounts. You structured transfers below reporting thresholds for 6 months, I said. You routed funds through undisclosed related entities. It's legal, he insisted. Then the review will confirm that. He lowered his voice. This is revenge for that dinner. The accusation was predictable. This is compliance, I replied. The timing is a consequence of your activity, not my emotions. He hung up. My mother called immediately afterward. You've destroyed us, she said. The bank initiated the freeze after reviewing transaction patterns, I explained. You reported your own family. I reported structured financial activity that triggered regulatory thresholds. You could have warned us. The bank did. She fell silent for a moment. What happens now? She asked. The bank conducts enhanced due diligence. They may request additional documentation. If discrepancies are resolved, access may be restored. And if they aren't, then the freeze becomes part of a broader investigation. Her breathing grew uneven. You're supposed to protect family, she said. I protect regulatory integrity, I replied. By mid-afternoon, Mercer Freight's vendors had begun calling the accounting department demanding payment clarification. Word spreads quickly when wire transfers fail. At 4:12 p.m., my supervisor stepped into my office. The freeze executed this morning, he confirmed. Federal reporting agencies have been notified. That was fast, I said. The pattern volume justified it. That evening, Daniel sent a final message. You could fix this. I did not respond. Compliance officers do not unfile reports because conversations become uncomfortable. 7 days earlier, my mother had positioned me as the one who lacked courage. Now the company she praised was under formal review because courage had been replaced with shortcuts. The bank had not frozen their accounts because of dinner. The bank froze them because structured transfers, undisclosed routing, and inconsistent disclosures reached a threshold that required action. Regulations do not interpret humiliation. They interpret numbers. And Mercer Freight's numbers had spoken. Account freezes are not final judgments. They are containment measures. Within 48 hours of the freeze, Mercer Freight received a formal request for documentation from the bank's financial crimes unit. The request was precise: source of funds for the structured transfers, contractual support for international expansion claims, disclosure of related party entities, and clarification of beneficial ownership for the intermediary LLC accounts. Daniel called again, this time less aggressive. They're asking for 6 months of back contracts, he said. We don't have finalized paperwork for some of those deals yet. Then the bank will note that, I replied. You know how growth works, he argued. You move first. Paperwork catches up. In regulated finance, I said, paperwork leads? 3 days later, federal inquiry letters were issued to the intermediary LLCs. The registered agent address linked directly to Daniel's consulting firm. That overlap had not been disclosed in Mercer Freight's annual banking update. Undisclosed related party routing is not automatically criminal. But when funds move repeatedly below reporting thresholds and then consolidate offshore, intent becomes a question regulators are obligated to ask. I was formally removed from any further internal handling of the case to eliminate appearance of bias. An independent investigative team took over. That was standard procedure once escalation crossed into potential federal review. Outside the bank, the consequences intensified. Payroll missed its deadline. Employees began asking questions. Vendors halted shipments pending payment confirmation. One of Mercer Freight's largest clients temporarily suspended contract renewals until the investigation clarified stability. My mother called me that evening, her voice no longer accusatory. "They're saying this could become criminal," she said quietly. "It depends on findings," I answered. Daniel told me it was normal structuring. "Structuring to avoid reporting requirements is not normal," I said. "I signed some authorization forms," she added hesitantly. "What kind of forms?" "Operating transfers. I didn't read all of them. He said it was standard routing." That detail mattered. If she had signed documentation authorizing undisclosed related entity transfers without understanding their purpose, liability expanded beyond Daniel. "Do not sign anything further without counsel," I told her. "You're not going to help us?" she asked. "I cannot interfere with an active regulatory process." She started to cry softly. At the office the next morning, I received a courtesy update from my supervisor. The investigative team had identified tax discrepancies tied to the intermediary LLCs. Revenue reported to the bank did not match revenue declared in recent quarterly tax filings. Inconsistent reporting across financial systems is one of the fastest triggers for regulatory escalation. Daniel called again that afternoon. "They're asking about offshore routing," he said. "Was there offshore routing?" I asked. He didn't answer directly. "It was temporary liquidity management," he said instead. "Through shell entities?" I asked. He exhaled sharply. "You think you're superior because you left," he said. "You think compliance makes you righteous." "This isn't about righteousness," I replied. "It's about disclosure." The investigation had moved beyond structured deposits. Now it was examining beneficial ownership transparency and potential tax misrepresentation. By the end of the week, Mercer Freight's credit line was suspended indefinitely pending resolution. For the first time, the consequences were not abstract. They were operational. Expansion plans halted. Contract negotiations paused. Reputation questioned. 7 days earlier, I had been seated at a dinner table while my mother framed me as insignificant. Now federal investigators were reviewing her son's financial architecture. The humiliation had not caused the freeze, but the freeze had revealed what humiliation tried to hide. Compliance does not create violations. It uncovers them. By the second week of the investigation, Mercer Freight was operating on partial cash reserves and manual payment approvals. The bank had not permanently seized funds, but the freeze remained in place, pending clarification. Outbound transfers required justification and supervisory sign-off. Incoming payments were monitored under enhanced scrutiny. Daniel requested an emergency meeting with the bank's Financial Crimes Division. He did not invite me. He didn't need to. I was no longer part of the review. But the outcome reached me anyway. The bank requested complete disclosure of beneficial ownership for the intermediary LLCs. They also requested documentation supporting the offshore wire transfers labeled as liquidity balancing. There was no offshore subsidiary registered under Mercer Freight's corporate disclosures, which meant the routing existed outside the declared structure. 2 days later, one of Daniel's internal managers resigned. Then the head of accounting requested personal legal counsel. Employees talk, especially when payroll becomes uncertain. My mother called that night. Her composure fractured. "They're saying Daniel could face charges," she whispered. "That depends on intent and documentation," I replied. "He said it was just temporary shifting to avoid unnecessary tax pressure." "That is not how tax law works." She began crying again. "I didn't know," she said. "He told me it was strategic." "Strategic does not override legal," I answered. By midweek, the bank escalated the case to federal financial regulators. That step does not happen casually. It requires sustained irregularity. Daniel sent me a single message that evening. "You could have handled this internally." I read it twice before replying. "Internal handling does not override federal reporting requirements." He did not respond. 3 days later, the official notice arrived. Mercer Freight was subject to formal financial review for potential structuring violations, tax reporting discrepancies, and undisclosed related party transfers. The bank extended the freeze pending regulatory guidance. One of the company's largest clients terminated their contract, citing financial uncertainty. Reputation collapses faster than revenue. My mother appeared at my apartment unannounced that weekend. She looked older than she had at dinner. "You didn't even argue," she said quietly. "About what?" I asked. "At the table. You just sat there." "Yes. You knew." "I knew there were irregularities," I said. "And you still let this happen?" "I did not cause it." She sank into a chair. "Daniel said it was normal," she repeated weakly. "Normal for whom?" I asked. There was no answer. What had started as structured deposits below reporting thresholds had unfolded into undisclosed routing, mismatched revenue declarations, and offshore consolidation. It was not a single mistake. It was a system, and systems unravel when examined. 7 days after the dinner, the bank froze their accounts. 14 days after the freeze, federal regulators entered the picture. Humiliation had lasted an evening. Consequences were lasting weeks. My mother looked at me and asked the question she should have asked before signing anything. "What do we do now?" I answered honestly. "You hire attorneys." For the first time, there was no audience, no dinner table, no applause for expansion, just documentation. And documentation does not laugh. The regulatory review lasted 3 months. During that time, Mercer Freight operated under restricted access. Every outgoing payment required justification. Every incoming transfer was flagged automatically for pattern analysis. The company's credit facilities remained suspended. Vendors tightened terms to cash only. Expansion projects stopped entirely. The investigation uncovered what the initial file only suggested. Daniel had created 2 intermediary LLCs 18 months earlier under a consulting classification. Those entities were technically legal. What made them problematic was their use. Funds were routed from Mercer Freight into the LLCs in structured increments below mandatory reporting thresholds. From there, consolidated transfers were wired to an offshore holding account registered in a jurisdiction known for limited disclosure transparency. The stated internal justification was tax efficiency and liquidity management. The problem was that none of this routing had been disclosed in Mercer Freight's official banking profile or annual compliance certification. Additionally, reported revenue figures submitted to the bank did not match the revenue declared on quarterly tax filings. That discrepancy triggered a secondary review by tax authorities. When confronted by investigators, Daniel argued that he intended to reintegrate the offshore funds after renegotiating supplier contracts. He claimed it was temporary cash shielding during expansion. Regulators do not evaluate intention. They evaluate documentation and disclosure. My mother's involvement became clearer as well. She had signed authorization forms allowing Daniel to act as managing agent for the intermediary LLCs. She testified that she believed the transfers were strategic diversification. Her signature appeared on 3 key documents enabling expanded routing authority. She had not read them carefully. That did not eliminate responsibility. I was formally interviewed as part of the review. The questioning was procedural. They asked about my prior role at Mercer Freight, my awareness of business operations, and whether I had any involvement in structuring decisions. I provided documentation showing my departure from the company 3 years earlier and clarified that my compliance review was assigned randomly through the bank's internal rotation system. "Did you act out of personal conflict?" one investigator asked directly. "No," I answered. "I acted under mandatory reporting requirements." That was verifiable. The suspicious activity report timeline predated the dinner humiliation narrative by weeks. The freeze had not been revenge. It had been threshold. By the end of the 3rd month, regulators reached a conclusion. There was insufficient evidence of intentional money laundering. However, there was substantial evidence of structured transactions designed to avoid reporting triggers and failure to disclose related party financial routing. Mercer Freight was fined heavily for regulatory noncompliance. Daniel was barred from serving as managing financial officer in any federally regulated entity for 5 years. The offshore accounts were closed. The company was required to submit to independent financial oversight for 24 months. The freeze lifted partially, but only under monitoring conditions. Expansion plans disappeared entirely. Investors withdrew. The humiliation dinner was never mentioned in any official document. Regulatory findings do not include family context, but consequences reshape it anyway. My mother called me after the settlement announcement. "It's over," she said quietly. "Is it?" I asked. "They're restructuring. Daniel can't run it the way he used to." "That may be safer," I replied. She paused. "I thought you were the weak one," she admitted. I did not respond. Compliance does not argue. It records. And once recorded, it moves forward. 6 months after the freeze, Mercer Freight still existed. Smaller, heavily monitored, no longer expanding into international routes, no longer presenting itself as aggressive and unstoppable. Daniel was no longer listed as managing director on any official filings. An external compliance officer had been appointed as part of the regulatory settlement. Every quarterly report required third-party verification before submission. The company survived, but it was not the same company that laughed at dinner. My mother invited me over again. Not for a dinner party, not for an audience. Just the two of us. The house felt quieter. No clients. No wine glasses set out for display. She poured coffee instead. "I've been thinking about that night," she said carefully. "So have I replied. "I wanted to make a point," she admitted. "I thought you needed to be reminded that you left." "I did leave," I said, "but not because I couldn't handle responsibility." She nodded slowly. "I didn't understand what you actually do," she continued. "I thought compliance meant paperwork. I didn't realize it meant accountability. It means documentation," I corrected gently. She looked down at her hands. "When the accounts froze, I assumed you did it," she said. "Out of anger. I filed a report because the pattern required it." "You didn't hesitate." "No, that's what scares me," she said. "It shouldn't," I answered. "It should reassure you." Silence settled between us. She had spent years praising Daniel's boldness and dismissing my caution. Growth was glamorous. Oversight was invisible. Until oversight became necessary. "I humiliated you," she said finally. "Yes," I replied. "And you didn't fight back." "I didn't need to." That was the truth she had not anticipated. Compliance does not retaliate. It activates. The dinner had been an attempt to reduce me publicly. The freeze had revealed something larger privately. "I signed things I didn't read," she admitted. "That's how most problems begin," I said. We sat there without hostility, just clarity. Daniel and I did not reconcile. He viewed the investigation as overreach. He believed expansion requires risk, and that risk sometimes pushes boundaries. Regulators disagree. So do banks. So do payroll systems when funds are frozen. The narrative of that dinner changed quietly over time. What began as Natalie left and failed became Natalie works in regulatory oversight. What sounded small became structural. One evening, months later, a former Mercer Freight client approached me at a professional networking event. "I heard you flagged something significant," he said carefully. "I followed protocol," I answered. He nodded. "That's rarer than it should be. Reputation rebuilds differently than ego. It builds through consistency. My mother no longer introduces me as someone who works in paperwork. She introduces me as someone who works in financial compliance." There's no sarcasm now. 7 days after she invited me to be humiliated, the bank froze their accounts. She thought the dinner established power. She forgot I work where power is measured in documentation. And documentation does not clap. It corrects.